So welcome back to another session, and today we'll be continuing with looking at the financial accounting cycle and narrowing in on adjustments and errors. However, today we'll be focusing on adjustments, though the question that we'll be looking at is a complete question. Right. Before we go any further, let's just go back to our definitions. Correcting entries where we're correcting errors are journal entries made to correct an error in a previously recorded transaction. And we had a few examples where we were correcting erroneous amounts made in a previous transaction and moving an amount from one account to another. There are other examples, but these are just a few, right? So we're looking now and we're narrowing in at adjusting entries. And these are recorded or required when changes in a certain account, right, have not been recorded in the accounting record. So when certain changes happen to the account, whether it be a prepayment or an accrual or anything of that matter, we need to adjust for stuff like that. So we had examples where we either had revenues or expenses or losses and gains with their related liabilities or assets for a transaction. It has occurred, right? But we have not yet recorded it in our general ledger accounts. And we'll go a little bit more in depth to that. So our question for today, our question states that Technical Institute is a school owned by June Wells, and they provide training to individuals who pay tuition directly to the school. We have below is the unadjusted trial balance, which was extracted from the books of the business at the end of the 2012 fiscal year. Right, we have our trial balance there, the unadjusted one. Then we have some additional data at June 30th, 2012, and it runs from A to I. Then we have other information done by the requirements. One, it says prepare the necessary year-end adjustments or the year-end adjusting journals for Technical Institute on January 30th, 2012. No narrations required. Two, we're doing the adjustments, we're filling in the adjustments and doing the adjusted trial balance in a worksheet, right? And we'll talk more about that worksheet. And the last requirement from the adjusted trial balance prepared, right? We're supposed to do the income statement, the statements of owner's equity, and the balance sheet, right? So that's the question. But before we go any further, we need to identify the accounting period, or what is also known as the financial year for this business. So what we know, as for the question, right, where we had our trial balance as at June 30th, 2012. So we know that's the year end. And an accounting year, financial year is a 12-month period, right? So 12 months up to June 30th would have begun on July 1, 2012. Therefore, the accounting period or the financial period under review is from July 1, 2012 to June 30th. July 1, 2011 to June 30th, 2012. So we'll be apportioning and appropriating the different figures to match this and so that they're classified properly as per the financial year that we are at, right? So our first requirement says that we're supposed to do the journal entries, right, for the adjusting information that we got, and that's for the additional data that you got as at June 30th, 2012. So let's look at those from A to I, all right? And we know when we're doing journal entries, we have the table format here that we put it in. We have the name of the business, the statement that we're doing what we're doing, the journal entry. We know our journal entry has the different columns. You have the date, the explanation. We'll talk more about what post-ref is. Then you have the debit column and the credit column, because if you're posting a journal, you have to debit and credit something, right? So let's go. The first one, an inventory count shows that teaching supplies costing $3,000 are on hand at June 30th, 2012. Right? What is this saying? So if we're supposed to look back at our trial balance that we have, right? What are we seeing for inventory? We're seeing where teaching supplies, that's our inventory, has a debit of $10,000. However, we're seeing here when we went to our storeroom or when we went to our warehouse, we're not seeing that $10,000 that the system is saying. We're seeing $3,000 worth of goods. So therefore, something happened, whether theft or some mishap with the system. Because a lot of businesses, and we'll think about this as a supermarket, right? So you go to the supermarket, and when you go to the cashier, they scan it. So that barcode reader, it updates the system. So each time someone purchase something, the count goes down, or if they return it and you carry back and get a refund, the count goes up. So the count is showing in this instance, right, from your trial balance, that there should be 10,000 worth of teaching supplies. However, in accounting, as much as the system can be right, you're always expected to do an inventory count. So the system is saying yes, 10,000. But when you went to do that inventory count, you are only seeing 3,000. So this means you need to adjust. You need to ensure that your records match what you have, because you can't keep $10,000 on your books. You don't have $10,000 worth. So you have to adjust your teaching supplies, which is an asset. And in adjusting it, we have to decrease it, right? So we'd have to decrease it by 7,000 because we're only seeing 3 and we had 10. So we have to take out 7,000. And when we're decreasing assets, we credit, right? So we're decreasing our teaching supplies asset account, but what are we debiting? All right. So this is now a loss that the business will have to take on, right? So therefore, we're going to have to expense this $7,000 in an effort to ensure that our records are showing at the end of the day, when we make this entry, when we do this adjustment, our balancing figure is gonna be teaching supplies in 3,000, matching our count. All right, let's continue. B, rent was paid on June 1, 2012 for 3 months to August 31st, 2012. Remember, our financial year, we're categorizing figures, right, to match our financial year July 1, 2011 to June 30th, 2012. So in this case, our financial year ends June 30th. So all our information that we have should be appropriately classified to say, as at June 30th, 2012, this is in relation to that, this is in relation to that, and so on. So here, on June 1, right, still within the financial year, you paid a rent figure for 3 months. You haven't lived the first month yet because you paid it June 1. And it's supposed to last for the entire June, July, and August, right? So what this therefore means is that we have on June 1, when you paid that rent expense and you decreased cash, right? What you did was you prepaid on your rent, right? You prepaid on your rent. So It will not just be rent expense because the expense was not yet incurred, because you did not live there for the month as yet. You haven't used per se that month because it's a business, it has been there, but you haven't lived out June 1's money. So because at June 1 we would have recorded this prepaid rent amount, we go up in our trial balance and we look, we're seeing that prepaid rent, a debit balance $9,000. We paid it for 3 months. So we're seeing that each month's rent is gonna be $3,000. Right? How many months have you lived at June 30th? How many months have you used up at June 30th? Because that's the end of your financial year that we're classifying and appropriating data properly. So at June 30th, 1 month is now no longer prepaid, but an expense that was incurred. So it's two things. First, we have to decrease our prepaid rent to now show that we've used 1 month of it. So what should be in prepaid rent should only be 2 months because we're still at June 30th. We don't use July or August as yet. So first we need to reduce prepaid rent, and we're seeing that it's an asset because it has a debit balance. So to reduce it, we have to credit it, right? And the next thing, which is the next side of the transaction, now we're going to be debiting rent expense because now that expense has incurred. You have actually used up this property for the month of June, right? So the expense has now occurred. So the entries for this is a debit to rent expense, right? Because the expense has been incurred, and a credit to prepaid rent, so as to reduce the amount that is in prepaid rent, in the prepaid rent account. So now your prepaid rent account is saying we only have 2 months being prepaid, and our rent expense is increasing by 1 month because one month of expense has been incurred. All right, let's look at C. Insurance premium of $24,000 for a 1-year insurance policy was paid on February 1, 2012. So similar to what we just did. And this is a more known one. So we know you pay car insurance and all types of insurance beforehand, right? So on February 1, 2012, remember we have to pay close attention to dates. So on February 1, 2012, you paid $24,000 for a 1-year insurance plan. So this insurance plan would come in full effect, right? Would be used up when? January 31st, 2013. Because if you count 12 months, 1 year from February 1, 2012, it will take you back to January 31st, 2013. So that's when all of this money would be used up. So we're seeing here where this insurance policy is playing, and it's playing through 2 financial years, the current one and the next one. So therefore, we need to show this, we need to classify this properly. So how much did we pay? We paid $24,000 for 12 months. How much is it per month? 24,000 divided by 12, and that is $2,000 per month, right? So in the beginning, when you paid it on February 1, it would have been prepaid insurance, but we're now at June 30th, right? All right, June 30th. So that would mean that February 1, March, April, May, and June's insurance would have been incurred because those months would have passed, right? So we need now to reduce prepaid insurance by 5 months because 5 months now is no longer prepaid. They have been used up, they have incurred. And reducing prepaid insurance, you have to then increase the expense. So we're reducing by crediting prepaid insurance, and we're increasing the expense for insurance. That's insurance expense because that 5 months has now been incurred, and it's $2,000 per month. So when we multiply that by 5, our answer is 10,000. So what we say we're doing, we're debiting insurance expense because the expense has now been incurred of 10,000, and we're crediting prepaid insurance to show that, okay, 5 months is no longer prepaid, right? We have gone through 5 months. Let's continue. So the company, or lie, the computer equipment is being depreciated over 5 years on a straight line method on the straight line method of depreciation down to a residue of $10,000. So we should be doing a video on depreciation in a bit, right? But we know there is 2 simple basic methods of calculating depreciation. You have the simple one, which is the straight line that they're asking you here, and you have the reducing balance, right? So let's look at the straight line. There is a formula for it. The formula says it's cost minus residue, and residue is resale value, divided by the number of useful life, the number of years you intend to use the asset for. That is the formula for straight line. We're calculating depreciation using the straight line method. But what is depreciation? Depreciation is what we call the wear and tear of assets. So because you're using this asset, though you purchased it for $20,000, because you're using it, at the end of this day or next week or next month, it is not still valued or worth $20,000 because you've used it, right? So it's lost some of its value. And this is why we calculate depreciation on assets, because we're using it in our businesses, right? So here, we're going to calculate the depreciation for this asset. So we're going to, in our trial balance, computer equipment, right? So we're seeing where computer equipment, it has a value of 160, and we said the formula is that's the cost, right? And the straight line depreciation says cost minus residue of 10,000, so that is 160 minus 10,000, leaving us with 150,000, and we're dividing by the number of useful years or life, and that's 5. So we're seeing here where the depreciation per year for our computer equipment is $30,000. How do we record depreciation expense, right? Our depreciation expense is always recorded by debiting depreciation expense and crediting what is known as accumulated depreciation. And you will do this per asset. So each asset will have its own depreciation and accumulated depreciation figure. And what accumulated depreciation is just depreciation over the years. So this year, you have 30,000, next year you might have 15. So you accumulated at that time would be the 30 plus the 50, right? Let's look at E. Office equipment costing $54,000 with an expected life of 3 years, right? It had no residual value and was acquired on November 1, 2011, and is being depreciated on the straight line method of depreciation. So again, here we are calculating depreciation. What do we say our formula is? The cost minus residue divided by expected life. So here the cost is $54,000. There is no residue. So it's 54 minus 0 equals 54 divided by the expected life of 3 years. So our depreciation, right, per year for this asset is $18,000. So I guess we can go ahead and just debit and credit $18,000. No, not so quick, man. When was this asset purchased? It was purchased November 1. So before, in the computer equipment, it didn't tell us when the asset was purchased. It was silent. So with that, it's the assumption that it was purchased at the beginning of the financial period. So it would be, we are assuming that it was purchased on July 1, 2011. So then it would have had 1 year worth of using, right? But this asset is specifically told us, no, you purchased it November 1, 2011. That's still within the financial year under review. However, it has not been used yet for 1 full year. So therefore, we cannot charge 1 full year's depreciation. So what this means is that we need to find the per month figure. So we know it's $18,000 for the year. When we divide that by 12, we get $1,500 per month, right? So after finding the per month, we're going to see how many months have we been using this. So November, December, January, February, March, April, May, June. So we've been using it for 8 months, right? So we'll multiply this per month figure 1,500 by 8, and we would have gotten 12,000. And that's the entry that we'll be putting here for E. So it's a debit to depreciation expense for what asset? Office furniture, and a credit to accumulated depreciation office equipment. All right. So that's the entry there. Let's move to F. On April 15th, 2012, the Institute agreed to offer a special 4-month course beginning immediately for an individual for a tuition fee of $3,000 per month, payable at the end of the class. The services are being provided as agreed and no payment has yet been received. So what this is saying, remember what type of business is it? It's an institution, it's a school, right? So you do courses. So on April 15, 2012, we're still within what? Our financial year. We're offering a special 4-month. That will be April, May, June, July, August. So that will be beyond the financial year under review. So we need to specifically and appropriately classify whatever information that we've gotten here. So how much would have been owed to us at June 30? Because this question is saying you have provided this service, right? You would have done this work. So this is what? Money earned, right? So up to June 30th, you would have earned some money, though no payment was received, right? So that money is revenue earned. And that money that you're supposed to collect is a receivable, right? So let's calculate the amount that is owed. So, and we're going up to June 30th. So April 15th, that's the halfway in the month. So April 15th to the end of April, that is half a month. Then we have full May and full June. So for 2.5 months, right, we've been providing this service to this person and they haven't paid us. How much money do they owe us? It's $3,000 per month. So 2 months is 6,000. And half of 3,000 is 1,500. So that's 7,500 that we have earned and that is owed to us. So it's owed to us, that's a receivable, and we're going to be debiting accounts receivable. And we have earned it. So we're going to be crediting. service revenue earned. And in this case, we're classifying the type of receivabilities. For a school, we do tuition, so it's tuition fees receivable. And the same thing for our revenue. What type of revenue are we earning? Tuition fees, right? So it would be the same as saying service revenue earned, tuition fees earned. That's our revenue. So that's the journal entry for it. G, a long-term note payable or the long-term note payable bears interest of 12%. The unadjusted interest expense account equals to the amount accrued for the first 3 quarters of 2012 fiscal year. The accrued interest for the last quarter has not yet been recorded. So let's look up at the interest expense account. So our interest expense account is saying 3,600. What do we know about this? We know that that is for the first 3 quarters, and the last quarter has not yet been recorded. It has not yet been paid or recorded. So we know that 3 quarters, 4 quarters make a whole, right? So if this is just 3 of the 4, if we're supposed to divide it by 3, we will get each quarter. So 3,600 divided by 3 gives us 1,200. So we know for every quarter, our interest expense is 1,200, right? And we know the last quarter has not yet been paid or recorded, but we're at the end of 2012. So this expense has been incurred. So we need to increase our interest expense. It's an expense, to increase it, we debit. So it has been incurred, but we haven't paid. So the other side to this is a payable, and we're crediting interest payable, and we're classifying, we're not just saying accounts payable. It's a special type of payable. It's interest payable. So here we're saying we're debiting interest expense and we're crediting interest payable. Right, let's look at H, almost there. On May 1, 2012, the Institute again agreed to offer this time a special 6-month course starting immediately for a client. The contract calls for a monthly fee of $2,500, and the client paid the first 5 months in advance. When the cash was received, unearned revenue or unearned tuition fees was credited. So at May 1, someone paid you for 5 months worth of class. So let's see how much this person paid us. So that's 2,500 times 5. They paid us 12,500. Right? So at May 1, as it says, this is unearned tuition fees, unearned because you have not done the work as yet that this was paid for. So if we're supposed to go up towards unearned tuition fees, or see where the 12,500 is credited, it has a credit balance. It suggests that it's a liability. So in the event that you don't teach this person, you owe them back this money. That's why it's unearned tuition fees and unearned revenue, right? However, this was at May 1. So when they gave you this money at May 1, it was unearned. However, we're at June 30th. So it would mean that you would have done the work for 2 months. So 2 months worth of this 12,500 has now become earned. So we need to what? Reduce unearned by 2 months and increase earned, because we're putting it now into earned revenue, right? So to reduce the unearned, we have to debit it. And to increase the earned, we have to credit it. And by 2 months, 2,500 times 2, that gives us 5,000. So let's look at the last additional information. it says employees earned $4,000 of unpaid and unrecorded salaries of as of June 30th, 2012. Excuse me. So when this says employees earned, it means that this is an expense, salaries that has incurred. However, it has not been paid or recorded. So the entries for this salaries expense, it was incurred. So we're debiting salaries expense, 4,000. And because it has not been paid, it's a payable, salaries payable, $4,000 is being credited. All right. So we've done all our journal entries for the adjustments, but let's look at this information here that says other information. It says the business is expected to make a $14,000 payment towards the note payable during the 2013 fiscal year. So just to jump the gun a little bit, this information, you have a note payable, which is a long-term note payable of $40,000. So if you know anything about loans, this is like a loan. So you had this loan, so separate and apart from interest that you pay. Each year you have to make a payment to the principal, right? The principal of 40,000, right? So what this is saying is within the next 12 months, right? Which is the 2030 fiscal year, because the fiscal year is 12 months. So at some point during that time, you need to make a payment towards this long-term loan, right? So this $14,000 is gonna be currently due because our current liabilities, that which is owed to us, that should be paid within 12 months. So within 12 months, this $14,000 need to pay. So in your current liabilities, you should see current portion or long-term note payable currently due, whatever you want to write it as, but this current portion of $14,000 will become due in the next fiscal year, in the next 12 months. So it is now a current liability. What does this mean for the long-term loan? It would mean that given that $14,000 is become due within the next 12 months and you are likely to pay it, it would mean that the amount that is long-term is going to be $14,000 less. So this is going to be 40,000 minus the 14,000, which will give you $26,000. So your long-term note payable is not going to be 40,000 anymore because 14,000 is become due. It's going to be 26. So that's just to explain that note. We'll pay closer attention to it when we're doing what? The balance sheet, because we were talking about liabilities, right? So we pay close attention to it when we're doing our balance sheet. So we have our adjustments and we have our unadjusted trial balance that we had from before. It's balanced, so we're good, right? The part 2 says we're supposed to put the adjustments, right, in a worksheet and prepare the adjusted trial balance. So what this worksheet really is really a table, right, with several columns and rows. And all we're doing is we're taking the debit and credit columns from your journal entry and placing it in this worksheet that we have here to the right? So you can see the unadjusted trial balance, the debits and the credit, and you have your accounts. So all we're going to be doing is taking these figures that we have and putting it in a table format, and we're going to call it adjustments, right? So you're going to see for everything that you made an adjustment for, and it will be on the same side that it was before from your journal entry. So let's try to find teaching supplies here. So teaching supplies explained in the adjustments column, you should see a debit of $7,000 teaching supplies account. We're seeing that 7,000. We look at teaching supplies, the asset, we're seeing a credit of $7,000. So we're basically just transferring this information in a table showing you the unadjusted trial balance, then showing you the adjustments, and now moving to get to our adjusted trial balance, right? And how we move from the unadjusted and the adjusted adjustments to the adjusted trial balance. So let me repeat that. How we move from the unadjusted trial balance with the adjustments to the adjusted trial balance, you can note it in our previous video where we were doing the suspense and we took the different journal entries, and you saw two ways where you could open the T account with the balance that you had in the unadjusted trial balance, right? Make the adjustments in the T account, then close it. Or you could simply look at the accounts. Remember we said, so for cash, nothing was done to cash, so the balance remains the same. However, let's look at tuition fees receivable. In the unadjusted trial balance, you had an $18,100 debit balance, right? You had an adjustment of $7,500. Remember what we said, if they're on the same side, right? All we do is to sum it and to keep it on the same side, right? The opposite is for teaching supplies, right? In teaching supplies, we had in our unadjusted trial balance, right, a debit entry of 10,000, but our adjustment says that we credited $7,000. So they're on opposite sides here, right? So what we do is we find the difference when they're on opposite sides. When the adjustments and what is in the unadjusted trial balance are on different sides, what we do is find the difference, and the difference is placed on the side of the higher amount. So we're doing that for teaching supplies, prepaid insurance, and prepaid rent, right? Because they're on opposite sides. We continue to office equipment, we did nothing there. The accumulated depreciation, nothing was there, so we just place it there and we go down and we continue forth, right? So as I said, if you want to see how to open the accounts and to close the T accounts, because we can do that, it's a little time consuming, but it will always ensure if you're following the steps, you will always get it correctly. So you can do either both ways to get the answers. But remember, at the end of the day, your adjusted trial balance must balance. Because as we said, if our adjusted trial balance is not balanced, what does that mean? Our financial statements or final accounts will not be balanced, right? So it is from the adjusted trial balance that we can do part 3, where we're preparing our income statement, or statements of owner's equity, and our balance sheet. So let's get to that. So we have our adjusted trial balance, right? We have the figures. So now we're going to be distinguishing what goes where. So from cash to our long-term note payable, all those are what? Or balance sheet items. So those items will be going to our balance sheet, right? Our capital and our withdrawals are what we call our SOE items, or statements of owner's equity. Though we know after doing our statements of owner's equity, we'll be moving with that balance to our balance sheet, right? And from tuition fees earned to depreciation expense of computer equipment, right? Those are our income statement items. And remember, we're using the figures from our adjusted trial balance. Those are the figures that we're paying attention to. So the first thing that we're doing is our income statement, right? So here we would have done several income statements before, and we've already identified, that's the great thing, what goes there, right? And we have it down, right? So our income statement, the key, the name of the business that we're doing. You need to have your heading, the name of the business, the statement that you're doing, and the period for which you're doing it for, right? In our income statement, we always start with our revenue. And on the revenue here was tuition fees earned, right? And we're using our adjusted trial balance figure. So that was 248,200, right? So that's there. What comes next? All our expenses, right? And we're listing our expenses. You have them here, right? From rent straight down to depreciation, we're listing it. However, it was listed here in descending order, meaning from the largest amount to the smallest amount, right? We total all our expenses. We would have gotten 166,200. Subtract that from our revenue, and we have a net income of $82,000. We double underline that figure to signify we're finished with this statement, and we're moving on to our statements of owner's equity. Again, we're looking back at our worksheet, right? For what items go into our statements of owner's equity. Remember, your income statement, your net income from your income statement goes in your statements of owner's equity. So again, we're starting with our heading, the name of the business, the statement that we're doing, right? And the period for which we are doing it for. And what we're starting it with here is opening capital. So you have June was capital as well. The capital at the beginning of the year, and that would have been July 1, 2011. And based on our adjusted trial balance, that amount is 156,000. Right? Next come adding our net income from our income statement. We have no additional investments, so we can go ahead and sum that there. Then we're subtracting what else is supposed to be in it, or withdrawals of 42,000. And we get capital at the end of the period to be 196,000, which we're taking to where? To our balance sheet. So we double underline this to show that what? We are finished with the statement, right? And we're moving to our balance sheet. So again here, we're looking back at what is going into our balance sheet. Remember, the type of balance sheet that this required us to do was the classified one, right? In the report format. So it's going to be looking a little different than what we've been doing, but the answer would have been the same. So this classified balance sheet is just the vertical format. We would have been doing the horizontal format, where it's looking like a T account. But the vertical format is just, instead of using the right and the left side, we're just going down from top to bottom. So again, we have the name of the institution, Technical Institute, the statement that we're doing the balance sheet, and the period we're doing it for, right? So in the vertical balance sheet, we're starting with our assets. And remember, we have two types of assets, current and long-term, right? And we're totaling current, then we're totaling non-current, same long-term, and then those two together gives you total assets, and that's where you double underline. Followed by that, you have your liability section. Now, in our horizontal format, this is what would have been on your right side. But instead of going on a right side and a left side, you're just going straight down. So again, we're dividing our liabilities like our assets into current and long term, right? Current means it is due within the next 12 months. Long term, beyond that. So remember, what we're paying attention to here is note payable. So remember in that last statement, it says the $14,000 is due within the next fiscal year, within the next 12 months. So that is become current. And in our long term, the difference is what? Still long term, the 26, right? So again, you total your current liabilities. You could have totaled your long term, but it was only one. So you could have put a figure there. Then you sum your liabilities to get a total liabilities figure, right? Afterward, the last thing, because our formula says assets equal liabilities plus what? Owner's equity. We have to now add owner's equity, and this is just taking the figure from our statement owner's figure. What I have here is an error. It should be 196 and not this 278 here. It should be 196,000. And then adding that to your 82,300, because remember, we sum all our liabilities already, right? Adding that to the 82,300 would give us 278,300, which gives us what our equation says. Assets 287,300 equals liabilities plus owner's equity, and that equals 278,300, right? So this is all our statements together. As I said, this was a lengthy question, but it was a full question, right? Just a few notes for you to know. When you're doing adjustments, what you're simply doing is updating your accounts, right? And you're guided by the principle of the revenue and the matching principle. We can do a video just diving in a little more on the different principles in accounting, right? And all this is saying, all this principle is saying, revenue is recognized, right, in the period that it's earned. So once you have done the work, right, the work agreed, you've earned that revenue. And that should be matched against expenses from that period, because those expenses were used to assist those revenue. And hence why we recognize expenses in the period that they incurred, in the period that they happened, not when it is paid, but in the period that it happened. Another thing to pay attention to is the headings for your statement. We know that you have to have the name of the company and the statement that you're doing, but how you record the periods. So for your income statement and your statement of owner's equity, it is 4-year ended, right? And you put the however you want to write the month date there. And for the balance sheet, it is as at. So income statement, statements of owner's equity for the period ended, then you have the date. But for your balance sheet, it is as at, then you have the date. A last point to note is that a business can either do monthly or annual adjustments. So that opening paragraph in whenever you get a question, that is important for you to read. However, if the question is silent, just as in depreciation, we assume that annual adjustments are being made. So that's the end of our question today. I just want to thank you for joining us, for sticking it out. I know it was a lot. I'd encourage you to go back, read the question again, go through what we watched the video, we watch it 2, 3, 4 times until you get it. Practice, right? Like this video. If it gave you any clear understanding, share it with someone who you think might be in need and who this will be useful for. Subscribe to our channel so you'll be able to see more videos like this, and leave a comment. What was I not so clear on, right? Or what were you not so clear on that I said. What other questions do you have? Do you have another question for me to answer that you'd like for me to answer? Drop it in the comment, send us an email, or DM us on Instagram. So I'll see you next week, tomorrow, for our next question. All right. Thanks for watching.